what will happen over the next 5 or 6 years is as the technologies that we're creating now start to mature, it will start to bring down the cost of producing them. So as a percentage of your income, it actually will start becoming cheaper. But it's going to take another half a decade for us to start feeling that with the technologies that we're pursuing today.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owners Association, where real estate investors have found success since 1968. I'm your host, Brian Hamrick from Hamrick Investment Group. This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 437. Everyone is paying close attention to the Federal Reserve and wondering when will they begin lowering interest rates. The lower than expected job report from 2 weeks ago certainly got people excited, but inflation is still being stubborn. What is really going on with our economy? And how can we cut through the noise of the popular media and focus on the data that really matters? In economic times of doubt, it helps to have Dr. Paul Isely make sense of what's really going on and what we should be paying attention to. Paul is the Associate Dean and Economist for Undergraduate Programs in the Seidman College of Business at Grand Valley State University. He may not always tell us what we want to hear, but when he speaks, everybody listens. Paul, welcome back and thanks for joining us today.
Thanks for having me.
When you spoke at the RPOA annual conference, our Midwest real estate conference back in February, you had a very important message for us as real estate investors. And I thought maybe we would start there. I mean, today we're recording this Wednesday, May 8th. This episode will be coming out on Monday. So it's going to be very topical and very timely because it's really a good opportunity to kind of give us an update of what you said back in February and what you see happening now. So what was it in February? What was your message then?
So the overarching message that we gave in February was that we had to watch the consumer. What had kept us out of a recession last year and what was keeping the Fed from lowering interest rates was the consumer was continuing to spend a lot of money. And what we were seeing is the very beginnings of them spending past their ability to spend as we got to the beginning of this year. So that's what we were talking about. And so we told everyone that as you went through the year, to use the consumer as your guide. As the consumer starts to pull back, that will be when you can start thinking about interest rates maybe going down.
So the consumer was a concern then. What are you seeing now? Is that still a concern or a greater concern, or has that concern gone away?
Yep. And in fact, some of the popular media is now starting to talk about this. So it's now gotten into a wider audience. But there's three things that's happening because there's three different ways you can get money to spend. One way you can earn it, one way you can use some of your savings, and one way you can borrow it. Okay, so earnings, the average person who's been working is making more money today than they did last year. And that's gone up faster than the rate of inflation. Okay, more people have come into the workforce, all right, but those people are being paid a little bit less because where we're seeing job expansion is in healthcare and places like healthcare and the government and leisure and hospitality. Actually, compared to our hiring rate from before the COVID, construction and manufacturing are actually not hiring as fast as they were before. So we're adding in lots and lots of additional workers, but those additional workers aren't earning as much as the people who are already working. Okay? So what we do know is, number one, individual workers are making more. Number two, when we add all workers together and add up all the money that they make and subtract the taxes that they pay, that their incomes are now going up only at the rate of inflation. So they're just keeping up with inflation now. Whereas over the last few years, they've gotten much better. So now they can't count on income allowing them to buy more stuff. All right. So that means they have to dive into their savings. And as we saw earlier this year, and we see now, they burnt through all of that excess savings they had from COVID. So they got all that excess government money. They couldn't spend money. They saved a lot of money. They've blown it all now. It's gone. All right. And now they're back to where they were before COVID started. So they don't have it there. And then they can borrow money. And they're borrowing money really, really, really fast. All right. So we know that credit card balances are going up. We know that people are borrowing money on Heliox. And we see people doing buy now, pay later. And the buy now, pay later is the scary part for economists because it doesn't show up in the credit report. All right. It doesn't show up in any of the government data. And the companies that do this don't tell us how much they've lent out. So we have a really hard time knowing how much people are using that in lieu of traditional borrowing.
Are you talking about credit cards with the buy now, pay later, or is it a different mechanism?
No, this is different than credit cards. So nowadays, when you go into many websites, you can get an option. Do you want to spread this payment out over weekly payments for the next 2 months or that type of stuff? So it's short-term loans, and you're buying it now, paying it later. And you normally pay the first installment when you buy it, and then every few weeks you have to pay more. All right. And a few years ago, that was for luxuries. Now we're starting to see people use it for things like groceries. So they're borrowing money essentially to buy groceries. That's not a good sign that the consumer is healthy. All right. So what we're seeing now is that they're borrowing, and we're seeing that young people are getting into trouble with their borrowing. So we've seen a big run up in getting late in your credit card payments. We've seen a big run up in getting late in your car payments. And we're starting to see it tick up in getting late in your mortgage payments. So all of that is telling us that the consumer has already tapped themselves out on their ability to borrow.
What is the outcome of that going to be, and what might prevent that outcome from happening?
What has to happen is they either have to earn a lot more money, and they're trying to do that, and they're doing it by taking second jobs, all right? Or deploying, if you're a family, deploying more workers, having your teenager work or having your spouse work if you were only working with one worker before. So we see multiple jobs. We're seeing families increase the total number of jobs they're doing, and that rate is growing fast enough that 1 in 3 jobs added since the pandemic has been people taking second jobs, not additional people choosing to work. All right. So that's one way that they can get out of this. The other way is they have to spend less money. And the places that they can spend less money, they've already started with. So they've cut back on luxuries. They've traded down the types of goods that they're buying. They're moving from brand name goods to store brand goods. And it's not getting them there. They need to cut back their spending even more. And the big numbers that they need to cut back are their transportation numbers and their housing numbers. So sooner or later, they got to find a way to decrease how much they're spending on that.
Let's talk about rental properties then, because this is the Rental Property Owner and Real Estate Investor podcast. What does that mean to us?
What we can say is that's going to start creating pressure on your ability to raise rents. Okay. If we look at moving averages, so smoothing out over time of the Zillow rent index, which is only looking at rents for the 40 to 60th percentile of renters. So it's not really bad housing units, and it's not people renting out the Taj Mahal. It's the stuff in between. And what we've seen is that it came way off of its highs, and the ability to increase rents dropped below what it was before the pandemic. Even here in Michigan, the Midwest has outperformed the coasts on this recently, okay? But what's been interesting is across Michigan is we started to see an increase in the fall of the ability to increase rents again. So So the longer term trend has been down, but the shorter term trend has been trending back up. But what we see is places that are still seeing population growth in the Midwest have their rents growing faster than inflation. Places that don't have population growth or have really low population growth have their rents growing slower than the rate of inflation.
Let's look at West Michigan here for a moment, because I know we're kind of an outlier with the rest of the country. And the rest of the country, from what I've been reading, is that there's a lot more supply that's come online. So there's less demand as that supply absorbs. So you're seeing falling rents across the country. But you get to the Midwest markets, and especially Grand Rapids and West Michigan here, and we are still seeing rent increases. Do you have any sense of how much longer that will continue? Can we still assume 2, 3, 4% rent increases a year, or is there a drop-off point?
This is where the psychology of the consumer starts to come into play. We know that they have to cut back, and so we know that they're going to maybe choose to cut back on housing. But if they choose to cut back on buying a new car, then they're still going to be able to afford those higher rents. But what we're seeing right now is that here in West Michigan, we have so many young people that the demand is outstripping the supply for housing. All right. And because that's the case, you're not going to see rents pull back too much, even as things slow down for the next couple of years. But then we start to lose those young people. So those young people have already moved up into the game. And so we'll have fewer and fewer new people entering that rental market as we get about 2, 3, 4 years out. And then all bets are off.
All right, you talk about the transportation costs, and I'm assuming you mean the cost of having a vehicle, maybe gas to get from home to work and back. I'm wondering if you see any of the technology that's coming online here having any effect on that, electric vehicles, rideshare programs, things like that. Because I do think that, personally, one of my beliefs is that technology will somehow help alleviate a lot of that transportation costs. And I'm wondering what your perspective is on that.
It will. The question is how long will it take to do that? So if we're looking at the short run, we have two things that have drastically increased people's cost of transportation. One is we've had a big run up in the price of gasoline over the last few months. And we're still up compared to last year. All right. So the fuel costs are going up. But the bigger issue, and it's an issue for both housing and cars, is the increase in insurance costs. So year over year, the insurance costs on a car are up 22%. And that's massively affecting people's ability to get into purchasing a vehicle. So now it gets down to how does that all play out if we share it out? Do we do ride shares? And that works if we have a high enough population density. So if you start having a high enough population density, we start to be able to look at sharing cars. We start to be able to look at different technologies for cars, electric bikes, smaller vehicles as options. And that really starts to play the game. What will happen over the next 5 or 6 years is as the technologies that we're creating now start to mature, it will start to bring down the cost of producing them. So as a percentage of your income, it actually will start becoming cheaper. But it's going to take another half a decade for us to start feeling that with the technologies that we're pursuing today.
You brought up insurance, which, some people link to inflation. Inflation has gone up, so insurance has gone up. But I don't see a corollary there. I think that insurance is, and I'm kind of circling back to property insurance, because what I've seen both in my portfolio and what I've heard from other investors is that insurance is rising not just at like 20% a year. I've seen it in my own portfolio rise 100 to 300%. That's got to have I don't know if that's really come back to bite us just yet, but that's got to have a massive effect on what real estate investors are going to have to charge in rent just to recoup the insurance costs. What are you seeing from your perspective?
That's certainly playing into the game right now. We're seeing, depending on where you live, depending on the risks that exist there, depending on what your baseline insurance rate was started. some really big increases in property insurance. And that is a function of the fact that industry has had a lot of bad years with some really bad luck with hurricanes, with tornadoes, with droughts, with forest fires, and it's costs an awful lot of money for them to handle that. So there are areas of the country where it's very, very hard to get insurance, and you're often stuck with the insurer of last resort. That's not the case here in the Midwest. We still have competition here. We still have more options here, but there's still unknown risks, and those unknown risks they're starting to build in. And then the second thing that they're doing is something that's always problematic when insurance goes too far with this. The reason you insure is to spread the risk across a bunch of people. Okay, so you're taking high risk and low risk, you're putting them together, and you're averaging that out, and that's what you're paying in your insurance cost. What insurance companies like to do is try and target exactly your risk and charge you more if you're riskier, and charge you less if you're not risky. Well, if they do that perfectly, there's no reason to insure because now if you're perfectly tagging my risk, they're charging me exactly what it would cost me to do it. So what's happening right now is with property insurance is the existence of cheap and high quality aerial platforms for them to look at your property has massively increased their ability to say your property has higher risks than even you think it is, and I'm going to charge you more for it.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com. I think part of the reason insurance is getting more expensive is because of all of the things that are going on around the country as far as fires, water issues, tornadoes. Do you have any models related to like climate change and how that might be affecting our economy here in the short term?
Yeah, I mean, we certainly run those models to look at it, and it's certainly one of the biggest problems with climate change, as we've seen it, is it's creating more volatility. So it's creating more volatility in the world around us. And that creates more volatility in the business world around housing or around anything you're doing. So as we look at things here in Michigan, we know certain things. We know already the growing season is 3 weeks longer. So that changes the types of agriculture there is. We know the weather pattern has changed. So we know certain parts of the year are wetter and certain parts of the year are drier. So it's now changing the types of crops you can do. It's changing the probability that you could have an adverse weather effect on a property. And the combination of those two things is affecting property values across.
MLive did a whole series about a year ago about climate refugees coming from other parts of the country, Michigan being somewhat of a climate haven. Do you have any projections as far as that's concerned? Like, should we be anticipating an influx of climate refugees here in Michigan?
So far, it's all anecdotal. And we know that those choosing to come here is being offset by those choosing to leave. So at this moment, as we look at Michigan, people are leaving faster than people are coming still. All right. It's getting closer. And there are parts of the state where more people are coming than leaving, like here on the west side of the state. But a lot of this has to do with Midwest rural locations, which are shrinking in size. And the fact that our population here is growing a lot older, and that older population is looking for a more steady temperature climate. So we're seeing them move south. So will we have that? I'm not sure we will see that with people, but we will see that with businesses. So we're already seeing that with agricultural businesses. We're already seeing that with server farms because your probability of losing a server farm has gone down. We've seen it with water-intensive industries that are now moving back into the Midwest after having been gone for many years. And all of that will lead to more jobs, which then might bring more people.
Let's switch gears and talk about interest rates, because I'm sure a lot of people ask you about interest rates. What do you see happening right now? I mean, we anticipated 3 or 4 cuts in 2024. We still haven't seen that yet. And now some people are saying we might not see any cuts. I mean, what's your perspective on that?
This is the tricky part. So what we've basically seen, for all intents and purposes, is rates moving sideways for the last 2 years. Right. There's been little ups and little downs, but mostly it's been moving sideways. And so the question is, when does the Federal Reserve change their stance on the short-term interest rate? All right. And that's going to be dependent on prices more than anything else. All right. And so what we're seeing right now is the prices are not getting down to what the Federal Reserve wants to see them at. So they like to see their preferred measure at 2%, and their preferred measure has been at between 2.5 and 3%. So they want to continue to slow the economy down. Okay? Slowing the economy down takes the pressure off those wage increases. And therefore, if those wage increases start to slow down, then we'll start to see a slowdown in inflation. So here's the interesting thing. If we look at inflation, if you buy things, it's already below 2%. If you buy services, it's still up near 7 or 8%. All right. So if you're buying a service, so housing and services are driving the inflation right now in the United States. Not buying things, not buying cars, not buying TVs, not buying fuel, not buying food. Those things aren't driving the economy anymore. It's those service side. And as a result, that is highly wage driven. And those wages now are going to continue to trend above the inflation rate for a few more years because they're already built into contracts. So we saw the UAW build a contract built on pretty high wage gains. We saw the FedEx do that. We saw all the airlines do that. We're seeing it. We're seeing fast food restaurants in California having 25% increases in their wage. All of those wage increases mean those services aren't going to be able to roll back their prices. And if they can't get their prices flattening out, then the Federal Reserve is going to continue to crank down on interest rates. They can't really slow down the service side much, but what they can slow down is that housing side. And so the longer they keep these rates higher, the more people can't get into that housing market, and the more deals that can't happen to build multifamily, and the tighter the housing market will get.
It almost seems like a doom loop there, where there are attempts to lower inflation on the rent side, or the housing side is only going to cause housing and rents to go even higher.
Yeah, and that's the problem. If you have to keep those interest rates high for too long, then you create that doom loop where now you aren't creating the housing that you need to do because the capital's not there to do it. All right. And lots of people are like, wait, the the rates are only 7-ish%, right? That's nothing compared to the 1990s and the 2000, in the 1980s. The real issue is it went from 3% to 7% and did that in only a year. So it'll be a few more years before people have gotten into a world where they're used to the rates at this level and can continue to make deals and do things under these conditions. So we don't expect the Federal Reserve to really pull back on interest rates very quickly. All right. And we didn't at the beginning of the year. We thought people were being too optimistic. And we still think people are being too optimistic. And the reason is those wage price pressures are so high. So I still think there's a shot at 50 basis points this year. So 2 quarter-point hits near the end of the year. We thought that they might be able to start as early as this summer, but they're not going to be able to unless the consumer takes a right turn. So one of the things that we're really worried about right now is that the consumer will reach a breaking point and then just stop, as opposed to trailing off. If they decide to just stop, then we get a recession, and a recession would result in us having decreases in interest rates even faster. And the risk for that is going up. We don't think it's going to happen yet, but the risk is certainly much higher now than it was in February when we talked.
Do you think the election that's coming up in November will have anything to do with interest rates? Well, will they lower interest rates because it's an election year, which is what I've heard some people say?
It's possible. I mean, the Fed chair is very aware that their job is on the line, depending on how the president reacts. All right. But I'm not sure Powell is looking for another term. And if he's not looking for another term, then he's immune to this. So they also have to be very careful to look like they're trying to benefit one party or the other. So if you do a bunch of rate cuts in October, then you're going to be accused of trying to help the incumbent party. And that has a bad look as well. So I think that the Federal Reserve at this point is probably going to stand pat until they get past the election, unless they can sneak one in early enough in the summer.
If housing is one of the inflation drivers right now, but yet we hear about falling rents across the country because of the supply that's come online and it's being absorbed, you're seeing rents either plateau or fall. Why is housing still up there in inflation? I mean, what's driving that?
So what you have to remember is some people have been in the same house or same rental property for 5 or 6 years, and now they're changing rental properties. So even though you're seeing a drop in rental properties compared to last year in many places in the U.S., you aren't seeing a drop in rental rates compared to 5 years ago. And often when you're in a rental property, your rates don't go up as fast as they do when you change properties. And so what we see is past inflation in rental rates or past inflation in new housing prices tends to have a 3 or 4 year tail on the end as people who were at that lower value trade into a new property and their prices go up. So it takes a few years for that to happen because only 10 to 15% of people change housing every year. So it takes a little while for it to work its way through the system.
Being a real estate investing show, what other data should real estate investors be looking at right now? I mean, obviously interest rates are very important to us, but what else should we be paying attention to?
I think if you start looking in that 5-year time horizon, we have to think about in the United States that drop off in millennials reaching a point where they're past that entry buying houses time. So that's going to take pressure off the entry market in sometime in the next 5 years. And what will keep that market alive or not keep that market alive is going to be how immigration is handled at the federal level. So depending on whether we continue to have new people come into an area other than just the birth rate, and we know what's going to happen with the birth rate. We know that that's dropping. Okay. that's going to create a demand side problem on the bottom part of the market. And it's going to happen sometime in the next 5 years if we don't see a resolution on immigration that allows that to backfill.
So as an economist, what do you want to see happen with immigration?
The answer is that we need to find a fair system which meets the needs of our employers without disadvantaging our current citizens. And that's a tall order. Politically, it's nearly impossible to do because the word fair means something different to everyone. And so it's nearly impossible to do politically. But what we do know is, given the growth that we're seeing, given the technologies that we think might happen over the next 5 years, we won't have enough technological growth to overcome the decrease in population available to work unless we allow more immigration and we allow targeted immigration that helps the workforce needs that we have.
I guess that brings up AI and robots. I mean, you don't think that the AI robots will solve that problem for us?
It's going to be very interesting there because we see AI and robots are affecting two different groups. So the robots are affecting the lower end group. So we're seeing robots even do things like take on the task of being a bus person in a restaurant to bus tables. Okay. 5 years ago, that wasn't economical. Now it is, because the price of entry-level work has gone so high and the price of the robots have come low enough that it's now cheaper to use the robot than a person. Okay. So we're already seeing that. We all know that if you go into a fast food restaurant, you're probably going to order from a tablet as opposed to a person. And they have preferred that you did it on your app before you came. So we know that that's already happening on that side. And that's going to affect the need for entry-level workers. Because of that drop in young people that we're seeing, we're not going to have enough younger people to fill those entry-level jobs. And there's going to be tightness in that market, certainly for the foreseeable future. AI is attacking middle managers and knowledge creators. So if you think back to the early 1990s when we created Excel and Word and Windows all at one time in the early 90s, and by the middle of the decade, the typing pool was gone, and lots and lots of middle managers had lost their jobs because you didn't need as many middle managers to create content for upper management to make decisions. Okay, we see AI right now being that same order of magnitude that we saw with Windows, Word, and Excel at the beginning of the 1990s. And if you think about that productivity growth that happened across the 1990s, that's an amazing growth. What's bad about it this time is it's going to be hurting people who are in their 50s. Okay. And if you're hurting people who are in their 50s, it's hard for them to retrain and get a job and do so in an economical manner. So it may actually constrain labor faster than we would think, because we're going to force people into retirement too early. And so it's going to be very interesting to see how that plays out. But it's going to be huge productivity gains, and those huge productivity gains will happen because we don't need as many middle managers. We don't need as many people coding. So you're already seeing that in big companies where they're already laying off people because of AI. In fact, if you look at earnings reports, we can already trace directly 150,000 people who have lost their jobs because their job has been replaced by AI, making somebody else more efficient. All right. And we know that the number is much larger than that. So remember that productivity increase, which is going to be good for the economy, isn't going to be good for every single worker.
You speak all over West Michigan, many different groups. What's the number one question people are asking you right now?
I think interest rates is probably the number one question I'm getting. Prices and interest rates are showing up all over the place. And I'm always asked, what black swan do you think is going to happen? And my answer is always, if I knew what the next black swan was, I wouldn't tell you, and I'd make a lot of bets and make a lot of money and retire. But we do have a lot of concerns with what's going on in the Ukraine. We do have a lot of concerns about what's going on in Israel, because those things can affect our prices for food and energy here in the United States very, very quickly. And that's even if things don't go really, really bad. All right. And certainly there's saber rattling that would suggest really, really bad. So generally really, really bad doesn't happen. So I don't build it into forecasts. But we do have to pay attention to those things because they could affect our interest rates. They could affect our prices in ways that don't follow any of our models. So we do have to worry about those. I am worried about the federal elections here in the United States. And I'm worried about them because the promises they're going to have to make to their core audiences to get elected are going to be beyond what the U.S. economy can support. All right. And if they push through those promises, we will result in a really bad 2030s. We won't feel bad for the next few years, but the 2030s will be really, really bad if we choose to spend too much right now.
Bad because of like the debt cliff that we're going to roll over?
Yeah. So as we get to the 2030s, we know we have greater debt issues. We know we have harder time meeting those debt issues. We know that we start having problems with some of our obligations. We know that the US dollar will be less important in 2030 than it is today, which has allowed us, that strength of the US dollar has allowed us to continue to borrow money at a lower rate than the rest of the world. At some point, we're going to be back to what the rest of the world pays, and our interest rates will be 1 to 2 percentage points higher. So we know all of that seems to come together in the 2030s. It's alleviated when enough of the baby boomers die. So as we get into the 2040s, the problem solves itself. But the 2030s have lots of expenses and little revenue. And if you have lots of expenses and little revenue, you have very little wiggle room to make it through that time unscathed.
Is there any sunshine here for real estate investors?
I think where we're at right now, we do know across the United States there's not enough product available. And therefore, the underlying value of property is going to continue to go up. All right. It doesn't mean in an individual area that it will, but it does mean that overall, that entire value of all the properties will go up, and will go up faster than inflation, because we're not going to be able to build stuff fast enough and the types of product that people want fast enough to keep up with that population growth. So you should always look to where the people want to be. You should always look to where the new factories are going, because that's going to be the places where there's going to be excess demand for housing.
Paul, how would people follow you or get a hold of you or find out more about you?
The one place that I do at least a moderate amount of stuff is on LinkedIn. So hooking in with me at LinkedIn, you'll see at least a few times a year updates. And if you come to the Grand Valley website, gvsu.edu/Seidman, we at several times during the course of the year do updates that are posted on our website.
Paul, thanks for joining us today, sharing your mid-year economic update. Always a pleasure talking with you, and you share so much great knowledge. It's a real pleasure having you on the show today.
Thank you. I enjoyed it.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's HIGinvestor.com.